Just over a month, the Federal Reserve is going to be meeting to discuss what to do with interest rates. Just 2 weeks ago, they kept that rate steady. I had the opportunity to talk with the president and chief executive officer of the Federal Reserve Bank of Cleveland, Beth Hammack. I asked her about what goes into the decision.
Each one of my 11 counterparts, when we show up in Washington, we try to give a viewpoint about what's going on in our region so that we can help represent more accurately what's there and then make sure that we're setting the economy so that it can really perform for everyone.
And so when you are weighing the decisions for the economy with your 11 colleagues, how challenging is it to have the political side that we all see as viewers versus the practical things that you're seeing when you make these kinds of visits?
Yeah, the independence of monetary policy is critically important so that when I and all of my 18 other colleagues walk in that room, we're squarely focused on the data and the experiences of everyday Americans and making sure that we're setting policy to deliver for them. If you look across the globe, what you'll find is that countries with independent central banks tend to have much better economic outcomes, much better lower inflation outcomes for their population. And it's important to recognize that we are independent, but we're accountable. The chair of the Federal Reserve meets with Congress twice a year. I'm out in the district talking to individuals, talking to businesses, sharing my viewpoints about what the factors are I'm looking at as I'm thinking about setting monetary policy, so that the public can understand exactly what it is that we're doing and why we're doing it.
And when's the next time you have to go to D.C. for this?
Middle of March.
And so what sort of things do you think are going to be, I mean, I don't know that you could tell us your vote, but what are you thinking of that you've picked up from your visits?
Yeah, so what I've been watching is how the labor force has been progressing. We had a little bit of softening in the jobs market towards the end of last year. It looks like it's stabilized as you got into the end of this year. And the most recent data that we saw this morning, it looks like the labor market is in better balance. Today's unemployment number came in at 4.3%, which is right around my estimate of that maximum employment side of our mandate. But on the other side, on the inflation side, it's been 2.8 is our most recent reading based on PCE inflation, which is above our 2% target. It's still too high, and we need to make sure that we can help bring that back down to target. So we're trying to balance those two sides. It's been a tricky time for monetary policy to weigh both of those together. I think policy right now is in a good position for us to wait and see how the numbers develop. And to me, if we see progress on both sides of our mandate, if we see more movement down on the unemployment rate and down on the inflation rate, I think that we're probably around a good long-term rate, and this is a place where we should stay from an interest rate perspective.
Do you worry that there's too much pressure from the White House to meddle, so to speak, in this?
I stay focused squarely on the job of delivering on that maximum employment and price stability. And for me, I really try to incorporate all the information that I'm getting from people around the district, the businesses, the community members, nonprofit organizations about what they're seeing when I go in and set that policy.